All right, so we'll get started. Thank you all for joining us today for the second Economic Insights webinar. Our senior economist and director of research, Tom Siems, is going to speak on the economy in quicksand. How and when will we get out of this quagmire? While Tom is presenting, please submit your questions in the chat and he'll answer them at the end. This webinar is being recorded and I will send it out afterwards along with a copy of Tom's slides. So now I'll turn it over to Tom.
Okay, great. Thank you, Katie. First of all, I just hope everyone is safe and healthy and that you're all doing well during this time. So it's May 6th, 2020, and we're going to talk about the economy in quicksand. So I'm trying to keep this a little bit shorter than last time so we can have a little bit more time maybe for some Q&A. And of course, the best way to do that is to send your questions in to Katie through the chat feature. And then at the end, she'll moderate a discussion. So we also took a little poll last time, and we decided after the poll to try to hold these monthly instead of quarterly. And that's probably a good thing because, you know, that way I can have an excuse to take a shower a little bit more often. You can see my hair is getting a little long back here. Next time, maybe I can put it in a ponytail. Won't that be fun? So let's get going on this thing. So let's see. What do I need to do? There we go. So the economy in quicksand, when will we get out of this quagmire? I got 4 questions I want to look at here. What about Bob? How bad will this recession be? What will it take to get the economy going again? And when will this economy rebound? So economy in quicksand, I've been fascinated with quicksand ever since I was a little kid. And, here's, in data analytics days, we can kind of look at quicksand this way. The funny thing is when I was a kid and, I thought quicksand was really going to be a bad deal. Turned out maybe it's not going to be so bad, but we'll see. But anyway, we instead of having a sandbox, we had a quicksand box. And eventually I became the only child. How about that? So here's some of my favorite shows that had some quicksand episodes in them. Let's Get Smart. We had Batman there, Pink Quicksand. What's up with that? I don't know. This is Lost in Space, if anybody remembers that. So there's quicksand everywhere, apparently. And, of course, Gilligan's Island, they had quicksand as well. And then some of my favorite comic strips also had quicksand. So it was kind of a big deal way back then. So I've been thinking about it for a long time. Now, what about Bob? So you might remember last time we talked about COVID-19 infects the U.S. economy, and I had these questions here, and I asked, are we in a recession? And it looked like, yeah, we're in a recession. And I took you back to the conclusion that I had in the December 2019 board presentation, and I highlight here recession ahead and Bob's. So the Bob was this bolt out of the blue. That's this unexpected event that can happen and can have a profound impact on the economy and on overall economic activity. And so, the bolt out of the blue here was the COVID-19 impact. Now, since I'm in professorial mode here, I want to talk a little bit about some texts that have guided my thinking over the years. Frank Knight was a famous economist in 1921. He published his dissertation, essentially. He did his dissertation at Cornell, and it turned it into this book, Risk, Uncertainty, and Profit. And he became one of the founding professors at the University of Chicago, known to economists as the Chicago School. And so you probably heard of some of the economists that have come out of that school: Milton Friedman, George Stigler, James Buchanan, Ronald Coase. These are all Nobel Prize winning economists. And he wrote this book, and basically, he's looking at businesses, he's looking at profits, and he differentiated economic risk that has known or that has outcomes that are unknown but governed by probabilities. So you can put some probabilities, attach them to various scenarios or outcomes. And that is very different from uncertainty, where the outcomes are also unknown, but you can't even put a probability on it or estimate what might happen. So it's really kind of this decision making under uncertain times. How do you do that? And so businesses, of course, are very good at managing risks. And in fact, banks are risk managers. I mean, that's what they do. They help businesses manage their risks. So out of this has come the term Knightian uncertainty. And it's now known as a lack of any quantifiable knowledge about some possible occurrence. So it's these situations where the probabilities are impossible to apply and quantify. And as a result, there's a recognition that there's a limit to our knowledge. So in other words, there are unpredictable events and risks that can't be managed or predicted. Well, a few years ago, Caleb wrote a book called The Black Swan. Now, he was a former Wall Street options trader and a risk analyst, and he wrote this to examine the ways in which humans try to make sense of unexpected events. And he argues that we rely too heavily on mathematical models, and we use statistical probabilities in a world with a lot of uncertainty, or these black swan events. So if you look at the probability distribution, these tail events that are out there, they exist, but we still try to model these. So he contends that when it comes to risks of really rare events, statisticians mask their incompetence with complicated equations. So if you can get past all the insults towards statisticians and economists in the book, there's a lot of lessons to be learned in there. And what's interesting is he's kind of one of these statisticians as well. And of course, I bring all of this up because I don't want you to hold me to the uncertain forecasts that you are about to see here. And so here's a good picture of a black swan event. The guy sitting on the park bench there, he's like, business is good, and our strategy's great, customers are happy, we got people engaged, and he doesn't even know he's about to get swallowed and taken over by this giant black swan that snuck up behind him, this very rare event. So the debate now is this bolt out of the blue, the COVID-19, rare event, which, by the way, pandemics have happened in the past. We've had other viruses in the past. There are probabilities and statistics around all these things, right? So the argument is, well, that wasn't the black swan. The black swan was the lockdown. And that's what most people didn't predict or expect. And as you recall, I said the great lockdown started with the March sadness that occurred on March 11th. And that's when the U.S. economy really fell into recession. We were not in a recession in February. And you can look in January and February, we knew about COVID-19. Now, I'm not minimizing this at all. And I don't mean to do that, but I'm bringing up that there are kind of two schools of thought now that are looking at the black swan event as either being this, the Bob that was the COVID-19, or the Bob that wound up being the economic shutdown. So how bad will the recession be? Well, we're going to do some forecasts here. And first, I just want to show you real U.S. GDP going back, this is about 70 or so years. The gray bars on here are the recession periods. And you can see at the very end, on the very right-hand side of this, a small dip down in the series. And that is the first quarter 2020 number. It came in at a minus 4.8%. That's on an annualized basis. If you look at a year-over-year change, it was pretty flat from where we were last year. It was actually positive at 0.3%. But that is down from what we were running at, about 2.1 to 2.3%, each quarter on this year-over-year basis. So overall, we're looking at a chart here that puts everything in $2012, and that's what real means, so that we look at a real series instead of an inflated series. And again, it goes all the way back to the late 1940s. So there are 11 recessions on here, and we've got number 12 that started probably about 8 weeks ago. So when we look at a recession, there's a couple of things that we look at. One is the expansion. That's the white areas in the chart. And then the contraction are those gray bars, and those are the declines that we have in economic activity. Now, I think the best way to determine how bad a recession will be is to look at the peak, which is the very end of the expansion and right when the recession started, and the trough, and look at the differential between the peak and the trough. For the financial crisis of 2008, 2009, that financial crisis, also known as the Great Recession, the decline was 4%. So a 4% decline in output from peak to trough. It took 18 months to go from that peak to that trough, or 6 quarters. So let's take a look, and that's kind of the other thing I think that's important to look at is how long does it take to go from the trough back to the former peak. Now, we're on a trend line. That doesn't mean we're getting back to our trend. It just means we finally got back to that point that we fell off. And for the financial crisis, it took 2 full years. It took 8 quarters to get from the bottom, which was June of 2009, to the middle of 2011 to get back to where we were at the beginning of 2007. Okay, hope all that makes sense. Now let's put all these together. Here are the 11 recessions that were on that chart, and just showing you the depths, not the lengths of each one. And you can see why the Great Recession got the moniker that it did. It was the deepest, and in fact, it was actually the longest of all of these recessions here. It was 18 months. Some of the other ones, like the 81-82 and the 73-75 recessions, were 16 months, but they didn't fall as much, but almost. Now let's take a look at this in a longer term perspective. And here I've added 3 recessions that occurred basically right at World War II and then pre-World War II, going back to the Great Depression. So that line on the bar on the very left-hand side of the chart there is the Great Depression of the 1930s. And so now you can see that even though the financial crisis was severe at minus 4%, it was nothing compared to the plus 25% decline we had in the Great Depression. And then, interestingly, we had this 1945 recession that nobody talks about. It was only 6 months long. It was a drop of 12.5%. And it was because at the end of World War II, you had all these soldiers coming home, and you had businesses and manufacturers that weren't geared up to hire them. They weren't geared up to make the stuff that the economy was ready for at the time. They didn't have transition stimulus packages back then. And so it took a few months for the businesses to ramp up, to hire the workers, and they came out of it very, very well and very quickly. So how bad will this recession that started about 7-8 weeks ago, how bad will it get? Well, Moody's Analytics is an excellent service, and they put together some forecasts and some scenarios of how the economy might play out. And I happen to agree with a lot of what they put together. And I've played around with them a little bit, probably renamed them from what they had. I did rename them from what they had. But basically what we have here is if the economy reopens in May, then that's the first red bar. If it reopens in June, that's the next scenario, then July, then August. And under any of these scenarios, we really have a a length of the recession probably in the neighborhood of 6 months. It's going to be pretty short. Okay, the second quarter, the April, the month we just went through, is probably going to be the worst month ever in the history of the world in terms of job loss and output loss and everything else. But now we're starting to see a little bit of activity with businesses opening and so forth. So when you look at those peak to trough declines, though, for the May reopen scenario, we've got about 10.5% drop. For June, it's about 11%. For July, it's about 11.5%. And for August, it's about 14%. Now, I'm going to return to these in a moment at the end of the talk and show you kind of how each one of them may play out both in the fallout and a subsequent recovery. But I think it's important here just at this point to note kind of the similarity maybe with the output declines here with the 45 recession, the fact that it's not as deep as the Great Depression. And I would attribute a lot of that to the $3 trillion of government support that has gone into the economy and the $2.5+ trillion that the Fed has already pumped in. Otherwise, without those sorts of things, we would have even more of a significant decline, I think. All right, so I'll get back to these here in a second, but let's take a look at the unemployment situation. If you've been following some of the blogs that I've been putting together, I haven't done it every week, but we've been updating these maps of the state level unemployment rates over time. So every week, the jobless numbers come out, and I'm sure all of you have seen it skyrocketed in that first, in March 21st there, it skyrocketed up like 6 million and another 6 million and 3 and 3. And so these are what we expect the unemployment rates to be over time, and it's put into this little animation here. And the darker areas are states that have the highest unemployment rates. And if I just kind of freeze that and show you the last pane there, I've got 10 states that we would project that currently, as of actually last week's jobless numbers, and by the way, we've got another report coming out tomorrow. It's probably going to have another 3 million that'll be added to it, but we've got 10 states here with unemployment rates over 25%. And the Great Depression overall for the U.S. economy was 24.7%. So currently, the unemployment rate is very likely above 20%. On Friday, the payroll employment report will come out, and also the household survey, and with that will come the April unemployment number. And most economists expect it to be between 16 and 20%. Now, why that? Why not up above 20, where I project it is today? There's a number of reasons for that. You have to be looking for work to be counted amongst the labor force, and there are a lot of people that got laid off, and they're like, "I'm fine. I'll just stay here. I'm not really looking for work." So there's some quirks, if you will, in the survey data in order to generate the correct number. So overall, though, it's going to be bad. It's going to be one of the worst months. With 30 million people out of work, that's the population of Texas. So that's a lot of folks. You can see here, Utah is the only state that has an unemployment rate on the rather low end. It's right just under 10%. And there's a few other Great Plains states in there, South Dakota, Nebraska, Wyoming, Colorado, that also have fairly low unemployment rates. I mean, these are not low, but they are fairly low compared to what we've seen in the past. And I've been asked, well, why? What's up with Utah, or what's up with South Dakota? And all I can really say here is that they are excellent at social distancing. And as this shows, in South Dakota, I got this from a friend, so a little shout out to Brett on this one. They've been practicing social distancing since 1889. And that might have the most to do with the fact that they're not seeing as big of a hit in those areas. All right, third question. what will it take to get the economy going again? First of all, some things have already started to happen. And you have to remember, I'm not the kind of doctor that helps people. That was according to my mother when I was able to put doctor in front of my name. She's like, not the kind that can help people. So there is a flattening of the curve, what I'm being told, on COVID-19. And that has helped ease the burden on a lot of hospitals, and it has slowed the spread of the virus. But the virus is still out there. This is not over, not even close. And so that has happened, but it's still, we're in quicksand, right? We're in this murky area where we don't know where it's going to go from here. Second, we've seen some states and businesses that have begun to reopen. Just last week, several states are reopening. And third, we've seen policymakers really go full throttle here. I mentioned the $3 trillion of increased government spending. We're almost at $3 trillion. They're talking about another $1 trillion package, I understand. We got monetary policy. I don't know if my number's right here. It's probably low, if nothing else. $2.5 trillion and counting. And the bottom line really is that economic growth should resume in the third quarter. Now, that doesn't mean we're coming right back to where we were, because there are still some things that need to happen. So let's kind of walk through some of these things that need to happen before we can experience robust economic growth. First of all, we're going to see businesses implementing new safety procedures. I was reading this morning about when Disney reopens, they're going to require masks, temperature checks when you come in. The lines are all going to be different. I mean, there's going to be some really big changes. You've seen in the airlines already a lot of new safety procedures. So we're going to have capacity limits, social distancing requirements. All of these are likely to eat into profit margins at businesses, and because they're going to increase costs and they're going to lower some of the revenues than that they had previously projected. Another thing that has to happen, consumers have to be comfortable going places. They have to be comfortable going into crowds, restaurants, bars, stores, football games. Frankly, we are not going to behave like we did in February of this year, or January, or go back to December if you like, and have that herd immunity unless we have a vaccine or a treatment
that makes you feel like a little horse
or testing of some kind. So it's going to take something big like that in order to get us all back. So that's the vaccine treatment. Some potential unintended consequences here. For government stimulus programs to be most effective, economists like to have this alliteration of TTT. It needs to be targeted, timely, and temporary. So whenever you see a government stimulus program, you might think about it. Is it targeted? Is it timely? And is it temporary? And so when you don't, you can have a situation that's described here, or even sometimes when you do, you can have this situation of unintended consequences. This is called a fixes that fail archetype in the systems thinking literature. And what happens is a solution is rapidly implemented to address the symptoms of an urgent problem. The quick fix sets into motion unintended consequences that aren't evident at first, but end up adding to the symptoms, or they create larger problems elsewhere. So what are some examples? Paying generous unemployment benefits might prolong joblessness and slow business reopenings and economic growth. So an op-ed about this for restaurants. The Fed's interventions could result in a balance sheet that is half the size of the U.S. economy. They're looking at a possible balance sheet of 10 trillion or more. And could all that new money eventually become inflationary as it gets, tossed about in the global economy? Supply chain disruptions can cause inventory and ordering problems. And that creates what's called a bullwhip effect. And that increases the inefficiencies for businesses and the productivity for the overall economy. And what about the PPP? This payroll protection program, for all of its benefits, what if it's not targeting the right businesses that most need the help? I read somewhere that there's an estimated 1 million micro businesses in the United States that could fail over the next year because they weren't able to bridge the gap from the time of the shutdown until the time of reopening and then have the same kind of business that they had previously. The bottom line here is all about confidence. We're going to continue to have a slog. We're going to continue to stay in the quicksand. It's going to be hard to get out until we see confidence rebound to some meaningful level. I showed this chart last time, showed you when March sadness begins, showed you the big drop. This is daily index of consumer sentiment that's put together by the Morning Consult. And it appears like it has stabilized in the 80-85 range. This morning's number was just under 85. However, it has not rebounded to a point where I think we need to see consumers actually being confident. What is that point? It's hard to say with this index. It doesn't have a lot of history, but I would think you have to get certainly over 100, probably over 105 in order to see the kinds of confidence in consumers that we'd like to see. Business confidence is also way down. In this particular series, it goes back about 20 years. Anything below zero is, much less confidence, I guess, or a concern, you might call it. Anything above zero is, things are progressing. There's growth. And so you can see that March sadness began for them same time, and it crossed that zero line and has not come back. All right, so let's take a look at now, when will this economy rebound? And I had mentioned earlier that Moody's Analytics puts together some nice scenarios. And I just want to take a minute here and walk through each one of the four scenarios and show you how GDP might trace out and also how the unemployment rate might trace out under each one of those scenarios. Now, the baseline scenario that they have, meaning that there's a 50-50 chance, could be better than this, 50-50 worse than this. This is kind of what, if Mark Zandi is talking about the economy, he's probably talking about this baseline projection. They're most confident in this one than any of the other ones. And overall, in 2020, these are year-over-year numbers. And so what that means is comparing the end of 2019 with the end of 2020, we see a drop in GDP of about 6.7%. And it's not the same as that peak to trough decline you saw of about 10.5%, because we have some rebound that's going to occur in the third and fourth quarters. In 2021, we have a pretty strong rebound, about 5.1%. The peak unemployment rate in this scenario is about 12.5%. That is a quarterly number of a 3-month average. So that's April, May, June, all averaged together to get that 12.5%. So that's why it's not up there at 16, 20%. You got that balanced out against hopefully lower unemployment rate numbers that we'll see in June and in July and months after that. And then we'll wind up with an unemployment rate around 8.4% at the end of the year. Again, I want to look at the point of the trough to the former peak. It would take 7 quarters to recover to get back to that point. So this is how that projection plays out. You see the steep drop in the second quarter. You see some comeback in the third quarter. You see a flatness in the fourth quarter, and then you see a tick up again. So we call this a W-shaped recession because it kind of has this double dip in it. And the reason for the double dip is because as businesses reopen and as consumers start to re-engage, they realize that it's not going to go as well as they thought. And so there's some pullback and some slowness that could occur after the initial rebound. And so whether they were going to call this a 6-month recession or a 9-month recession or a year, remains to be seen. But this pattern would be expected, and actually is expected amongst all those scenarios, with a little bit of a choppy look to it as we kind of adjust to whatever might be the new normal. Here's the spike in the unemployment rate in the second quarter, about 12.5%, comes down by the end of the year. And then again, we got this time period, we got a lot of fallout that we're going to have to deal with in terms of debt and business reopenings and skill lags and all kinds of things that may end up having workers out of work for much longer than they had anticipated. And remember, this is like it's not the best case scenario, but it's the most likely scenario that is expected. So what if we have a June reopen? Well, Moody's would put about a 25% probability on that. So it's a little bit worse. I think they call it a 75% scenario, but same thing. And you can see much steeper drop in GDP in 2020, not as strong of a rebound in 2021. Unemployment rates both a little bit higher. And it takes an additional quarter to recover from that. So that's still not too bad. I mean, it's bad, but it's not as bad as you're going to see on what happens if we have a July or August scenario. So same kind of pattern. You start to see the W get pushed out a little further and a little flatter in the third and fourth quarters of this year. And then the unemployment rate this year would be about the same, but it would have somewhat of a lagged effect in 2021, according to this scenario. With a July reopen, that's the 10% probability or chance. You have about a 10% decline year over year in 2020, and you don't have as robust of a rebound going forward because there's more debt issues, there's more problems that spill over to other industries, to the financial sector, et cetera. The unemployment rates are now getting higher than they were in these other scenarios, and it takes 11 quarters to recover. So this starts to look pretty bad. And now, instead of a W-shaped recovery, we have essentially a U-shaped recovery that drags along the bottom for about a year before it starts to rebound and come back in any kind of meaningful way. And again, the unemployment rate scenarios play out in a far worse pattern. And then finally, you go to their 4% scenario, in August reopen, and things are even worse. Under this scenario, you would have negative interest rates at the 10-year for probably the entire year of 2021. Really high peak unemployment rate if we wait a long, long time to reopen businesses in the economy and keep workers at home, and end up in double digits still throughout the year and into 2021. It would take a full 4 years to recover from this. This is bad. This is incredibly long time. 48 months is longer than the Great Depression under this scenario. So this is like hopefully a worst case scenario. Very much a U-shaped here, but the rebound is sluggish and slow, and the unemployment rates follow that same kind of pattern, but at a much sharper rate initially, and then in the 21, 22, and beyond. So it persists in the economy. All right, now I thought that you might be interested to know what happens in your own state, so I plotted all 50 here. Hopefully you can find yours. I call this a spaghetti chart. This is under the baseline scenario, the May reopening, and you won't be able to find your state in there, but I wanted you to see this so that you can see that all states suffer, all states fall into recession, all states follow the kind of the similar pattern here. Some go much deeper than others. And it's generally, if you look at the map that I had produced earlier with those unemployment rates, it's those Great Plains states that suffer the least. It's the states like Michigan, like New York, like Washington, that have some of the biggest declines. So, but they all rebound. They all rebound back. It's actually some of the states that go the deepest rebound the most. So you can see kind of like that brown line there is the deepest, in the second quarter, and it's one of the highest later. That doesn't mean that it's going to come out better in the end. It just means that they went deeper, so they got deeper further to come back. So I had a question that came in on state revenue shortfalls that could get hit from various taxes, and I don't have answers for that. I'll give you my pat, economist answer. It depends, right? On the one hand, it could be this. On the other hand, it could be that. And what it depends on, of course, is the strength of the recovery, the length of the fallout, all the things we've kind of looked at here. But also, each state kind of collects their tax revenues in different ways. And so I kind of made a list of some of the ways you can collect revenues. And so income taxes, okay, that's going to be down for everybody. Sales taxes, down for everybody. Well, I back up, though, because there's some states that don't have a sales tax, and there's some states that don't have an income tax. But overall, income taxes are down, sales taxes are down. Even in states like where I live in Texas, if I'm buying food now at the grocery store, that's not the same as buying food at a restaurant. I don't pay taxes at the grocery store on sales, but I do it at a restaurant. Property taxes. That's one that's probably going to be fairly stable because the assessments are done. But if we get in one of these really bad scenarios, then those will start dropping. Corporate taxes, that's going to be hit. Gaming taxes, obviously, probably non-existent right now, which is one of the big hits to states like Nevada. Energy taxes, okay, Texas takes in some oil revenue and oil in the tank, down, what I mean by that, in the tank, is a big hit. And then you have sin taxes. That's probably one thing that might be up, unfortunately. So we'll see about that. But what the overall impact is yet, I don't know. It is something that I'm interested in and would like to give some further thought to and maybe do some research on. And so hopefully in the future you'll see a blog on that. By the way, I did a blog on this that got released probably just right about now. And so you can find that out on our website, or you can go to LinkedIn and you can find CSBS, or you can find me. And you can, like us and follow us and all that good stuff too. All right, so what's the conclusion here? Well, there is evidence that the lockdown was as much of a black swan event as the COVID-19. No one expected a pandemic, and no one expected the government to shutter everything and ask everyone to stay at home for an extended period of time, which I believe we're in day 51 now in some areas. The recession that started in March will be deep and likely exceeding 10% peak to trough, and may end up looking like the 45 recession in terms of that, peak to trough, in terms of depth and in terms of length. Hopefully we can keep this to 6 months and start to rebound in the third quarter. And while I expect that we will rebound then, the path forward depends on consumers and businesses being confident, again, in engaging with one another. Kind of like, when is it safe to go back outside? And it's going to take a few things here, a vaccine or treatment or quick testing is going to help. Policy makers really have gone all in here, but confidence is going to be the overall key, and that's what's going to help the most. So with that, I'll bring Katie back in, hopefully, and we can see if anybody had any questions and we can entertain them.
Thanks, Tom. So we don't have any questions as of now. I did receive one in my email, though. So while people start thinking of questions and typing them in, I'll go ahead and ask you this one. So the question is, the lockdown has been very disruptive to our educational system, particularly high schools and universities. Do you have thoughts on the longer-term impact on employment market and the educational system?
Excellent question. I've been thinking a lot about that. I taught for 20 years at SMU, and I actually did a lot of online teaching while I was there. They had a pretty robust systems engineering program that reached out to a lot of folks in the military that were all over the world. So I know that we can teach remotely. It can be done. There are ways to do it. I'm actually taking a class right now, and it's online as well. So there are going to be some big changes, I think, in particular in higher ed. The model hasn't been sustainable for years. Tuition has been rising faster than the rate of inflation, almost double the rate of inflation for a good 20, 25 years now. And that price is become exceedingly high for a lot of folks. And so there's going to have to be some ways in order to lower costs. And, I read this morning, will students even be allowed to go back on campus next semester? Some universities are considering not allowing folks, not allowing the students back on. So there's going to be some big impacts. There's going to be some big hits. The money is not going to be as free flowing as it used to be. There might not be as much of a need for the same kinds of building requirements that they have with classrooms and so forth. And so I'm concerned about it, because that's what makes America great, really, is our university system. The people from around the world come to the United States to be educated here. We've got something like 16 of the top 20 universities in the world right here in the United States, and we've got more Nobel Prize winners at our universities than are anywhere else in the world. So we need to have a strong university system, but it'd probably be bifurcated. In other words, there'll still be these elite schools where you go to and so forth, but there's probably going to be more online available through other avenues and through community colleges and that sort of thing. All right, so I rambled. I don't know if I... It's what I do best, is answering questions.
So we got a big flood of questions that came in while you were talking, so that's good. So
Okay.
First one here, what impact will forbearance have on mortgage lenders and servicers going forward?
Yeah, I wish I knew that answer too. It's another one of those, it depends. We're watching that super closely because it's going to have an impact, on the person, on the lender, on the service providers. I mean, all along that supply chain, if you will. If this is quick, if we can get people back to work quickly, then we should be able to get past this without big problems. And so that's the big if. How quickly can we get back to some kind of new normal where we have enough people back in the labor force? We've knocked out 30 million people already onto the unemployment rolls. Another 3 million likely coming tomorrow on that report from last week. We need to get those folks back into the workforce so we can start paying bills and doing stuff. So I don't have the answer on that one, but we're keeping an eye on it at CSBS for sure.
So in your model on reopening, how do you define reopening? Is that 100%, 75, 50, etc.?
So it's not, and again, these are Moody's scenarios, and I've read through them, and I tend to agree with them. It's not like, all right, we're all, back out there, nobody's wearing masks, and we're all good and happy and going to bars and all that again, like we were in, let's say, December. Not like that at all. They've looked at it by industry, first of all. What industries can reopen? Accounting offices, things like that can reopen, but businesses that require people getting together in large groups are much less likely to reopen. So they've tried to look at it by industry, kind of what makes most sense for being able to reopen now, and they've transitioned that out for all those scenarios. The lockdown, if you will, from, when you look at the May, June, July, August scenario, is kind of like, that you're just, everyone has to kind of stay at home. So we don't even start, until June, just try to reopen businesses. We don't start until July to start reopening businesses. And so those prolonged periods are what's causing the sharp declines and high unemployment rates in the in the July and August scenarios in particular. So it does take into consideration some kind of transition, that it doesn't happen all at once, that restaurants might allow 25% tables, and they'll rearrange themselves and that kind of stuff.
Okay. And to go along with this question, we have a few questions asking about, do you have models that assess the damage of reopening now and then having to reclose everything again in the fall if we have another wave?
Not yet. Don't have that yet. It's a big fear, right? That this could come back, in the fall or in the winter or early next year again, and require kind of the same thing again. So again, that's why the treatment, the vaccine, that's why that's so important, because that's really the only thing that's going to make people comfortable again with herd immunity and getting out there and doing things. So don't have one that'd be even worse probably than that August reopen scenario. Yeah.
Right. So the next question we have is about the oil. So is that actually helping recovery with the cheaper inputs and new storage, transportation infrastructures that are needed?
So say that again, about oil prices, or?
So is it actually helping the recovery because of they need new storage and they need more transportation infrastructure because of oil?
Yeah, so energy is one of those things that, of course, it hurts the workers in the industry and a lot of businesses that are peripherally associated with that. But then it helps those that are energy consumers, energy users. Right now we're not driving, so that's why we're seeing gas prices so low, and airlines probably get as much fuel as they want. So the question on is it a good thing or a bad thing is yes. It's a kind of another one of those. It depends on what you're looking at. It's going to be hard on the industry. The industry is going to be laying off a lot of people. It used to be on net, when oil prices went down, that was good for the overall economy. Now we're kind of seeing that on net, that's not the case, because we become such an efficient energy producer that we derive a lot of income from that industry. But there's not a lot of employees in it relative to the whole rest of the economy. About 80% of the economy is service workers. And those are the hardest hit right now. The food, accommodation, travel, resort, museums, and all those kinds of things that have been shut down. So it's going to help for some industries and for some period of time during the recovery. It'll keep costs a little bit lower, but it'll also result in a very difficult time for workers in those industries, in the energy industry, to get back to work.
So the next question we have here is, how do you see the meatpacking closures impacting the overall economy? Reduced capacity due to employee illness will likely impact grocery stores, restaurants as they reopen.
Right. So this is when I talked about the bullwhip effect. This is kind of one of the classic current examples of what can happen. So you have demand. You have high demand for, let's say, meat. And so they ramp up and they want to produce more, but all of a sudden then they're shut down. And so it puts a big swing in orders and inventories and everything. And what the bullwhip effect kind of means is one change here can result in bigger changes down the way. So you look at the one end of the bullwhip and it doesn't move very much, and the other end it moves a lot. And so it's gonna cause some problems. And in fact, it's not the only industry where you're gonna see problems. Anything that had these surges in demand or impacts on the supply side are gonna have these inventory shortages. And it all contributes to inefficiency in the economy. It impacts transportation, getting things to places. It impacts then when you go to the store and they say you can only buy one, or you can, you have to get in line, or you have to get on a waiting list for some items, like I can't get a pull golf cart, things like that. You wind up on waiting lists for stuff. And so for the whole meat packing thing, it's happened on both sides is the problem. On the demand side, on the supply side is what I mean by both sides. On the demand side, you've seen kind of a surge in demand for some meat products. People are kind of like, I got to fill up my freezer. And then on the supply side, they had to close down. And so getting all that supply chain back to working properly is going to result in shortages in certain areas. It could result in surpluses in other areas. I mean, it's just not smooth like when we have a normal free market economy that is able to get the right goods to the right people at the right times for the right prices.
So that was the last question we received. We have about 8 minutes left. Okay, looks like another question came in. So how quickly do you think we will see how businesses use real estate change?
Businesses see real estate change? Is that what it was?
Yeah, how quickly do you think we'll see how businesses use real estate change?
Okay, so if I'm understanding the question, so is it when will real estate prices change, like commercial real estate prices? Is that what the question is? Not sure I got it exactly.
Okay, so it says how quickly, how quickly do you think we will see how businesses use real estate change? So
use, okay.
The use
okay,
of it,
I think,
yeah.
Okay, yeah. Actually, it could be pretty quick for some businesses, right? I think what's being referred to here is that many businesses have learned how to work remote, and then there's other businesses that are probably going to have to close up shop. And so all of that is going to transition probably fairly quickly. If you think you can continue to have remote workers, there's I think a high likelihood that you might change the way that you have folks come into your office, especially because we're going to have all these new procedures, to probably get into places. We're probably going to have to get temperature checked. We're probably going to have a mask on. What about getting on subways, airplanes, all of that kind of stuff. So technology is a key here because we're going to want to use technology to the full, like we are today, be able to do this, from my home, which is nice, which is cool. But I think the transition will happen quickly, and it could result in, not as much demand for commercial real estate, at least in the short term. Now, we still need to get together. I mean, there's nothing like getting together, talking to people. You don't get as much body language on this. I'm not seeing anybody. I'm not seeing the frowns on their faces or the anger, getting all mad at me or whatever. And I can't pick up on it. But if I had you in a live room, I can kind of work with that and play off of that. So that'll never be replaced. And the relationships is really important. And that's, we're built that way as human beings. So I hope that we get to work quickly. And I hope it's not super disruptive.
So we have another question here. Your projection shows less unemployment and overall impact in the Upper Plains, but agriculture is getting crushed right now. With heavy ag presence in these states, how do they come out of this better than the other states?
So that's a really good question, and I think it could be the case that the data set that I use to make those projections is based on payroll employment, which is probably non-farm payroll employment. So it could be excluding that segment. And if that's a big part of the Plains economy, then it could be understating those numbers. So that's an excellent point. That there could be an understatement in the projections for those states, particularly if they're being hard hit. Yeah.
Right. So along the lines with the real estate question, so how do you think the housing market will be affected by changes to commercial real estate usage, and do you see a housing market crash coming?
Oh boy, put me on the spot here.
Big one.
Actually, I do not see a housing market crash coming. I'm holding kind of to that baseline May reopen scenario that we're going to kind of slowly be able to get things back here in the next couple of months, and that housing will stay fairly steady. It's not going to crash, I don't think. I mean, the prices may drop some over the next year or two, but I don't think it's going to be anything, certainly nothing along the magnitudes of what we saw in the Great Recession. There's just doesn't seem to be that kind of a, at this point. But I remain open to being able to reassess my position.
So I have another question here. Based on previous recessions, how does the unemployment rate correlate to people unable to pay their mortgage payments?
I haven't looked at that yet. I think it's too early to kind of say. And again, with the stimulus, monies that were sent out, the $1,200 checks that were sent to folks, and the forbearance issues and so forth, it's still a little bit too early to assess that impact on the payments. Again, I'm hopeful that there was enough stimulus. I mean, think about the total amount, right? $3 trillion with just federal money. We have a $20 trillion economy. That's like 1.5 months or 2 months. That's 2 months of economic output that the federal government has put into the economy. Now, I know it's not all there. Not all 3 trillion made it yet. It was passed, but it's not in there. But then you get the Fed pumping in another 2.5 on the lending side. That's a lot of stimulus money that should cushion the blow to consumers to be able to pay some of the debts that they have coming up. I hope.
All right, so that was our last question.
Perfect.
Yeah, that's great. So we're right at 3:58. Don't see any more questions coming in. So I'm going to just thank everybody for joining us today. I will be sending out an email to everybody with this recording, as well as the slides, and a feedback survey. Definitely want to get your thoughts. So thank you again for everybody for joining, and have a good afternoon.
All right. Thanks, Katie.